I confirm you can see my screen, right?
Yes, sir.
All right, thank you.
Yes, sir.
A moment. A moment. All right. So in the first class that we had, we talked about accounting and business. So we'll talk about what is accounting, what is business. We talk about what is the definition of accounting. Sorry, a moment. Sorry, there was a call from one of the people. Sorry. So as I was saying, I said on the first class we talked about accounting and business. Those that were available, they will attest to talking about business. We said business is anything that you do, any trading activity that you do that involves you exchanging your goods or services or both of them for money. That is what we said. Um, business a business is, and we talk about different kind of business. We have the partnership, we have the sole proprietorship, we have the company limited liability company, and all of that. And we have rules that guides them on what they need to do, the kind of financial reporting they need to do. So I don't know if I think the class was recorded. So maybe you can check our YouTube page and just to catch up. So today we'll be going into chapter 2. We've already spent like 10 minutes. So I'll run through this chapter 2. It's a bit like 3 pages for my summarized notes. Then we'll now move to chapter 3. Then we'll see if we're able to do anything much from there. So, like you all know, I am Bukola. So my name is not Gafaro. I'm using that account so that I can use it for recording purpose. Me, I don't have subscribed Gmail account, So I am Bukola Olale. So I'll be taking you the FA for this moment. So feel free to ask any question at any point in time. If you have any clarity that you need to know, or you have any question you need to ask, feel free to ask. I'll try as much as possible in my little understanding to provide solution as much as possible. I hope I'm audible. If I'm not audible enough, please let me know.
Yes, yes, sir. You're audible.
Thank you. Right. So we'll be going into the chapter 2, which is the International Accounting Standard Board's conceptual framework. So now we have accounting, we have principles, concept, conventions, rules, regulations that guide accounting. And here now we're talking about the conceptual framework. So we have a body called International Accounting Standard Boards. So like or maybe you may not know so much about it. We have several accounting concepts. We have several accounting concepts, which is all this materiality, uh, prudence, faithful representation. All of these things are put together for you to be able to, for every financial statement you see that has been prepared, it is assumed that, especially when it's a public limited liability company, if you work in a public limited liability company, a PLC company, you understand that all their financial statements have been prepared in alignment with one, the international financial reporting standards or international accounting standards, and two, the law of the land. For instance, this is Nigeria now, we have KAMA. We have other rules, other laws like bank and other financial institution, BOFIA, that guides the banking industry. So all these laws will be considered in preparing the financial statements of any company, especially when it's a public limited liability company. Now, it is required for them to prepare it in alignment with the standards because we don't want the users of the financial statement to be misled. Now, some of us might have heard about the cases of the case of Cabri, when they falsify the financial statements. I mean, like, just imagine that you're working in a company now, and as big as Cabri is, just imagine that they declared that they have asset of, maybe let's assume 1 billion naira, and they do not even have anything close to that. They definitely have assets, but then if they are declaring 1 billion naira, they may be having only 200 million naira. So meaning that 80% of what was declared, they are false. And it goes down to their inventory as well. They were telling the the public that they have huge inventory, and all of the inventory are just falsified. So all of that put together makes accounting standards to become a regulatory framework, a conceptual framework that organization must follow in preparing. Because if I'm to buy shares in Cabri, then I mean, when I see that the company is doing well in terms of their revenue, in terms of their inventory, in terms of their assets, I look at their liquidity position, I see, oh, these people are doing very well. Because when you're calculating for instance, your ratio analysis, if you want to calculate your ratio analysis, if you want to calculate your ratio analysis, you look into, for instance, now you're looking at, is it current ratio, current asset divided by current liability. Now you're looking at current assets over current liability. When you've overstated your current assets, meaning that you are now saying you have huge current assets, whereas it's not real. I would have used your current assets of maybe 1 billion naira divided by the current liability. Then I look at, oh, the ratio is very huge. I look at, oh, these people have a whole lot of um, good liquidity position. So I will use that to make decision, but then the decision I'm making is wrong. And that is why we have International Accounting Standard Board's conceptual framework to guide in preparing all these things. Now, the meaning of gap. So gap is a generally accepted accounting principles. We call it gap. Gap concepts is a principle, convention, laws, rules, regulations that are used to prepare the financial statements. That is what we know as gap. So what that means is that you're looking into comparability, you're looking into prudence, you're looking into going concern, you're looking into faithful representation, you're looking into relevance, you're looking into timeliness. All these things, we'll still get there. Huh? So all these things are what are put together to make sure the financial statements are prepared in alignment with concepts, principles, convention, laws, regulations, and rules. so that people will have rest of mind that what we have prepared, they are fine and true, right? Then we have the meaning of conceptual framework. So the conceptual framework is a system of concepts and principles that underpin the preparation of financial statement. So those principles, those concepts that we need to take into consideration, those accounting standards that we need to, for instance, now you have a standard we call IAS 16. IAS 16 is the one that defined assets. IAS 2 defined inventory. Now, if I want to recognize an asset, there are conditions that are stipulated by IAS 16 for me to follow before I can say this is an asset. Before I can say something is an inventory, there are things that IAS 2 have stipulated that this is what you must use for you to say this is an inventory. And like that for revenue, these are key things that make up a financial statement. Those are the concepts and principles that guides the preparation of financial statement. And all these concepts that we are using, for instance, now, if you usually depreciate your assets on a straight line basis, we believe that asset is an estimate. I mean, depreciation is an estimate. Now, if you are trying to depreciate your assets and you have been using straight line method, if you want to change the straight line method to reducing balance method, it is expected that it is communicated, because that means you are no longer staying in the consistency line. You must be consistent. That's what we are saying. You must be consistent with the preparation or the standard that you are using. So the purpose of conceptual framework is foundation for accounting. So number one, conceptual framework serves as the foundation of accounting standards. What do I mean by foundation? Without the conceptual framework, we believe that what we are doing, they may not be so right. So for us to know that what we are doing is right, we already have a foundation. Now, after the foundation, we are trying to avoid arbitrary standards. So there are some standards that, before we usually use SAS, Statement of Accounting Standards. Those ones are outdated. In those days, you have all those container accounts, all those royalty accounts, and like that in the past. Now, we are using International Accounting Standards Board, IAS or IFRS. So let me try to be jotting a little. So when I say IAS, maybe some of us may know International Accounting Standard. Then we have IFRS, International Financial Reporting Standards. So all these two, they are under the IASB watch. These are the principles that are being given by IASB for us to prepare our financial statements. So then to fill in gaps in standards. What do they mean by that? Is that the conceptual framework helps us to be able to say, okay, these are the gaps that we are seeing in standard. It is the conceptual framework that will pinpoint out that there is for instance, we usually do what's it called? IFRS 16 lease. Before it used to be IAS I think it's IAS 15, if I'm not mistaken. Can't remember the exact IAS. So that IAS was lease. It used to be lease before it's now changed to IFRS 16. Now, IFRS 16 now is talking about lease. Before, there used to be finance lease, operating lease. Now, IFRS 16 has consolidated it. So we are trying to look at where are gaps, because before, people usually, what they are supposed to state as a finance lease, they will put it in their book as operating lease, meaning that they are trying to adjust their financial statements to bring a better picture, which is not true to the people. Then we have guidance for unusual transactions. So, let's assume you are recognizing asset now. Asset is not what you are doing every time. It's not every time your company is buying a PPE. So now somebody like you that's, oh, how do I now recognize this kind of asset? That's why IS 16 will guide you on, is it qualified to be an asset and how you're supposed to recognize it in your book. Then it enhances credibility. Like it makes our works to, like, you can confidently say that I've followed all the necessary steps. So this report is prepared in a true and fair view. So basically, we're just trying to say, what are the purpose that conceptual framework gives us? It is to ensure that there is foundation, we are avoiding arbitrary standards, it's filling the gaps in standards, then it gives guidance to unusual transactions, then the credibility is certain. So that is what we mean by the purpose of conceptual framework. Then we have the alternative to the conceptual framework. We have alternative. What's the alternative? The alternative is rule-based. What does it mean by rule-based? I think I've explained principle-based and rule-based before, but for the purpose of the class, I will explain again. Now, we say rule-based means that this is the way it is done, that is the way you must do it. But principle-based gives you the room for you to be able to use your discretion. It gives room for flexibility for you to be able to apply the accounting standards in what you do. For instance, now, if I say uh, it's illegal for you to say you will not pay tax. That's an illegal act. So that is rule. It's a rule. Must you pay tax? Yes, you must pay. If you don't pay tax, you can't confidently go on a public radio station and say, I'm not paying tax and I will not pay tax. You can't do it because it's illegal. They will take you up. But in a principle-based setup, we are saying, okay, this is the principle. Follow it the way it is supposed to be followed. Just align yourself with that principle. So there is flexibility, and that is why in a situation whereby we have a treatment that is being stated by that is in the Nigerian, maybe in a Kama rule. Kama is a Company and Allied Matters Act. Kama. So we have Kama. Kama is the Company and Allied Matters Act that guides the rule of all companies that are registered in Nigeria. So everything, they are the one that will say they must do AGM, they are the one that they will say they must file every 6 months. All those laws, they are being controlled by Kama. Now, Kama is Company and Allied Matters Act. Now, this Kama, they are responsible. So they have some laws. Now, in a situation whereby laws of Kama is opposing that of International Accounting Standard Board, IFRS, or IAS, whichever one. If it opposes, IASB says you should take priority for that Kama. Why? Because Kama is the one that knows the situation in Nigeria better than IASB. IASB, you should understand that they are from UK. They are majorly from UK, so they do all these standards too. I think it's only US that is not adopting the IASB standards. They have their own US GAAP that they use. So this one that we use in Nigeria, most countries in the world, it is UK GAAP. So Kama, in the situation whereby Kama rule oppose that of IASB, it is expected that Kama knows better than IASB in Nigeria. So IASB is saying, take the Kama rule to treat it in your book. And that is where it is principle based, not rule based. Because if it's rule based, it's not possible. You have to do it the way it is stated in the book. And the rule based gives room for creative accounting. People try to, when we say creative accounting, do anybody know what is creative accounting? Anybody? Nobody? Everywhere is so dull. Wow. Are we getting it?
Yes, sir.
Yes, sir. Yes, sir.
Ah. But nobody knows creative accounting like this now.
No, sir.
Okay. Okay, so when we say creative accounting, we are saying uh we are making the financial statement to look better than it actually does in the real sense. What I mean by that is, let's say your asset is supposed to be worth 2 billion. Now you now say your asset is worth 5 billion. You are pushing it up. You are creating. So this 5 billion, you will put accounting entries, or you put debit and credit, debit asset, credit this one, that one. You will do it like it's real. So it's creativity. You are creating something that does not exist. That's what I mean by creating a creative accounting. And that's what happened in Cabri. If some of you heard how Cabri was had issue at some point, they had to dispose of all their directors and all of that. That still affected Cabri till today. Maybe they should have been bigger than what they are now, but it affected them a lot. So because they were saying their inventory is this, whereas they didn't produce any inventory as such. So those things are creativity. Sometimes some people call it window dressing, like you are portraying it to look better than the way it actually does. It is not real, but then you are making them to understand that, man, this is what is there, which is not real. So that's what I mean by creative accounting. So when it's rule based, when you are putting rule in place, it makes it difficult for people to have flexibility. So let me move. The IASB conceptual framework. The conceptual framework deals with. So what are the things that conceptual framework deals with? One, talking about the objective of financial reporting. The objective of financial reporting, the qualitative characteristics of useful financial information, the definition, measurement of the element from which financial statements are construed. So all these things are, how do I put it? So for instance, now we have objective of financial. What's the objective of financial reporting? The objective of financial reporting is to ensure that the users of financial statement get adequate information that is true and fair view, and they get it as and when due for their uses. So for them to be able to use it, they get this information for them to be able to use it for what they need it for, and they are able to rely on it that it is. So that is the objective of financial reporting. The objective of financial reporting is that we report the financial statement in a way that is true and fair view and that satisfy the need of the users of because there is no essence of financial reporting if it's not satisfying the users. Then we have quantitative characteristics of useful financial information. Now, qualitative, like the financial information must carry quality, like it shouldn't be done shabbily. It is something that can ruin somebody's life. Imagine you are buying a share of a company, you are investing maybe all your savings on it, and you realize it's a lie. The company now liquidates, man. Somebody can die through it. So we are trying to be sure that these are qualitative. So those are the concept of capital and capital maintenance. Capital, anything capital is a long-term asset. It's something that we believe that it's a property, plant and equipment asset like PPE, an asset that they are used for quite a number of years before they are expected to be fully depreciated. Then definition and recognition measurement element. So it is through this conceptual framework that we're able to know what's definition, what is the definition for an asset. For instance, now, if I'm to define asset now, I do not need to be thinking about it in my head. Oh, what is asset? What is asset? Because IAS 16 International Accounting Standard Board 16 have given me a definition for IAS 16. And it says asset is a resource that is being controlled by an entity as a result of past events, and that the future economic benefit will flow to the entity. So I do not need to be thinking about what is an asset, because there is something that has defined it for me. The conceptual framework has given me the definition through IAS 16. Then it has given me, how do I recognize assets? What are the things I need to consider to recognize an asset? How do I measure it? So if I want to recognize an asset now, I need to recognize it. Is it measurable? Can I measure it? Is it something that can attach value to? So I need to consider those things. Then the measurement, how do I measure it? What are the things I need to put into consideration? So those are the things that conceptual framework deals with. So who are the users of financial? Here are the users of the financial information. So we have investors, people that want to invest their money, the lenders, people that want to, like banks, other creditors, maybe you want to borrow from elsewhere. You have the employee, you have the management of the company, they need those financial info. You have the government as well. Government will use those information to be able to make decision. You can see maybe Federal Inland Revenue Service or Lagos State Internal Revenue Service to come and meet you now for audit, and they will not use your financial. They need your financial statement, because that's where they believe you are using to record everything you do. Now we have objectives of general purpose financial statements. Now, so like I said, the objective of financial statement is to provide useful financial information to existing and potential investors, lenders. So it is to provide adequate, useful information, financial information to the users of financial statements, such as, so for them to be able to make decision as regard resource allocation, buying, selling, holding equity, debts, and all of that. So it is this financial statement that will help them to know, do I need to? That's why if you are somebody that buy assets, no, if you are somebody that buys shares of companies, you will see that if they want to release maybe something 1 quarter Q1 report, you will see that is either the asset, the shares of that company goes up in value or it comes down in value. Why? Because some information must have gone through that, oh, this is their new financial statement they want to release. It is negative. This one, it is, or things are going down for them. That means people will want to sell all this. As people are selling the shares off, the company value will be dropping. So you that did not sell on time, you just see that your money have gone to something you do not like because you have slept on it. So, and if the money is going to, if what they are going to be reporting is going to be, for instance, now, you can't tell me you buy Tesla share in the last 1 year. You must have made a whole lot of gains. Why? Because, Tesla is a leading company in the world, one of the leading companies in the world, that they are doing inventive things through Elon Musk. Now, if you buy their share, you'll be rest assured that, oh, it will grow. Why? Because if you even buy it in the last 1 year, it has doubled, more than double by now. So if you bought it in the last 1 year, it's more than double now. So meaning that I think as at that time it should be maybe 140 something or 150 something about a year ago. Now it's about, is it 3 something or 4 something? So it should be 4 something now. Now it means because that company have value, it grows. Because the company is having value, it grows. People are enjoying what Elon Musk is doing. People are enjoying what the company is doing. So it's making people to trust the business. The business grows. The financial statement they are releasing, people are getting more interest in it and people want to buy. So it makes their shares to become scarce for people to buy. So then we have qualitative characteristics of useful financial information. Now, these ones are things that are very important for you to know. So we have the IASB, the International Accounting Standard Board Conceptual Framework, describes fundamental qualitative characteristics and enhancing qualitative characteristics. Now, fundamental qualitative characteristics, they are the ones that, the fundamental, just like as the name sounds, the fundamental, they are fundamental. Like without them, I mean, every other thing is zero. Where we have the enhancing, like you are trying to make it more presentable, you are like trying to make it more meaningful to people. But the fundamental ones, they are number one, the relevance, the faithful representation, then the materiality. Now, when I say relevance, it means what is the how relevant is that financial statement to the users? What is the relevance? How are people able to use the financial statements to make decisions? How are people able to use it to make decisions? How are people able to say, okay, because I'm making use of this, I can rely heavily on this to make my decision? So then we have this predictive value there. So predictive value is talking about you are able to predict what the value is looking like. So you can easily forecast what the future looks like. I mean, what it looks like when you're looking at your financial statements. Then the confirmatory value is like you are saying this is the value. You are confirming what exists, the confirmatory value. Are we getting it?
Yes, sir.
Right. So
Yes,
then
sir.
we have the, okay, thank you. So the predictive value, like I said, is like you are able to say, okay, this is like their forecasts. So more like you did a financial projection for your organization. That is one. Then this confirmatory is talking from the aspect of the financial statements have been audited. More like you are able to confirm the figures. This is what it is, and that is the way it is. So it is not something like you are saying is an estimate. No, this is the way it is, and nothing changes it. That is the way it is. Nothing changes it. So that is what we mean by relevance. Then the relevance is split into predictive and confirmatory value. Then we have faithful representation. Faithful representation means that the financial statement is prepared complete and it is prepared in true and fair view, and it is neutral from every form of errors. So when like you have a financial statement, you have your balance sheet, you have your profit or loss, you have your cash flow, you have your notes to the account, you have your comparative figures, all of them done. Now, we are saying this financial statement you are presenting to me, is it prepared in true and fair view? Yes, no. Then you'll now be able to answer. Is it prepared? Is it incomplete? Is it complete? What is it neutral? When we say something is neutral, we mean is it free from bias? Not like you stylishly told me, okay, let's recognize this ones as inventory, even though I know they are not inventory. You get now. So those things are wrong. So that means the financial statement is non-neutral. The preparation is non-neutral. Then is it free from errors? Errors are not deliberate mistakes. Most times they're like an omission, more like, and it may even be coming from somebody that is not experienced enough that have treated it. So those are errors. So we must check these things, are they free from errors? If the errors are material, then there's an issue. Or if the errors are immaterial, then there is no issue. Then we have materiality concepts. Under this materiality concept, we're able to say something is material when the omission from the financial statements will grossly affect the outcome of that company. What I mean by that, in fact, IASB stipulated that anything more than, I think, if I'm not mistaken, 5% of that financial statement, once it's more than 5%, then it is material. Okay, let me give an example. Now, let's say revenue of a company. Let's say is 3 billion. Is it 3 billion? I wrote 3 million. So let's say 3 million. Now, it will be material for you to say equals 0.05 times this. Now, you agree with me that if you omit something that is worth 150,000 naira from 3 million naira, I mean, you want to cause trouble. But let's say the money is like maybe 20K from 3 million. Yes, it's money, but then the omission of that 20,000 naira will not be as high as you are talking of this kind of 150,000 naira. Well, let's say, okay, let me change this to like 10%. Look at it, 300,000 naira. I mean, if you are omitting like 300,000 naira from the financial statement of 3 million naira revenue, then you're going to cause an issue, because it means that instead of you reporting this 3 million naira, you have reported 2.7 million naira, or you have reported 3 million naira instead of reporting 2.7 million naira. It's a huge figure, but 20,000 naira may not be so material to affect that financial statement in there. So that is materiality. Materiality is the weights, whatever have weights, that the omission will make the entity to suffer for what they have reported. That is material. That is material. Then we have enhancing qualitative characteristics. The enhancing qualitative characteristics are, we have comparability. So what they mean by comparability is this. Let's say we have in 2020, let's say 2024, then we have 2023. So we are saying that we have, let's say we have figures for all this. Let's say we have let's say we have assets, let's say we have liability, let's say we have equity. So here, let's say we have 1, let's say we have 550. Now, comparative is saying that you need to show us what 2023 figure says. Your asset in 2023, let's say it's 1,800. Let's say this one is 900. Then let's say this one is still 550. So it means you have fulfilled the comparative figures, enhancing characteristics. So IASB, International Accounting Standard Board, is saying if you are preparing your financial statements and it's not your first year, there must be a comparative analysis like this. 2024, 2023. They are not doing it for designs. When you see financial statements like this, they are doing it for comparative purpose, because it's a standard that you have to follow. It's a principle that is guiding the preparation of financial statements. Then we have verifiability. How have they been checked? Your financial statement, have they been verified? Who verified it? Who says your asset is your asset? Your liability is your liability. Those your receivables, are they receivables? Those your payables, are they payables? Are they real? That's verifiability. Then we have timeliness. Are you able to prepare it when it is needed? preparation of that. So you must be prepared when it is needed, not when it is out of time. Then we have understandability. I mean, if your financial statement is ambiguous, it's going to be irrelevant. So you have to make sure that your financial statements are prepared in an understanding manner. So we have recognition of financial statements. So IASB gives us how to recognize financial statements. Number one, you are recognizing financial statements by identifying that it meets the financial statement elements definition. Just like I mentioned the other time, I defined assets. I said assets. Assets. So I can say asset is a resource controlled by an entity as a result of past events, and that the future economic benefits will flow to the entity. Now, if I want to define an asset now, that is okay. Let me use this analogy now. Now, you look at yourself. I mean, some people will say, oh, you're an asset to the company, you are not an asset. Abi, right? You are to an extent, yes. But then look at this now. Look at this scenario. Are you a resource to your company? Oh, yeah, let's answer. Are you a resource? Nobody's talking. Are you a resource to your organization? Anybody? All of us, are we not working?
Yes,
Yes,
sir.
We are working, right?
Yes, sir.
So I'm asking, are you a resource to your organization?
Yes, sir.
yes,
You are
sir.
a
Yes.
resource. Okay. So you
Yes.
are a resource, yes. Can you be controlled by your organization? Are you controlled? If they say
Yes, sir.
sit here,
Yes,
you
sir.
sit there. If they say you cannot go in the next this year, you will not be able to go. Are you?
No.
No,
Yeah.
not
No,
in
sir.
No.
that regard.
Okay. Are you giving economic benefit to your organization? You know, you are rendering your
Yes, sir.
service, like you have made,
Yes, sir.
yes, right?
Yes, sir.
And this is the reason why a human being is not an asset to an organization. Just because we did not meet this criteria. That's why we are not an asset. You cannot fully say you are an asset to an organization according to IASB standard. Why? Because IAS 16 defined, IAS 16 is called PPE. IAS 16 defined an asset as a resource that is being controlled by an entity as a result of past events, and that the future economic benefit will flow to the entity. Yes, you are a resource to the organization, certainly. But can you be controlled? No. You can wake up tomorrow and say, me Oshemo, I don't do again. I don't work
Yeah.
again. The only thing is they will tell you, okay, you have to give us 1 month notice. You can even say, I'm not giving you any month notice. Bring your lawyer. I bring my lawyer. Yes, they cannot control you. So that is why, but the economic benefits, you are giving them economic benefit because you are using your brain to tell them, okay, we need to do it like this so that there won't be issue. We will not have issue with tax authority. We need to deduct this tax from this person. We need to remit this amount to the government, because you are giving that your experience to put things in alignment. But then this control is a no. You can wake up tomorrow and say, in fact, nature can even say you will not be able to go out again. God forbid. Somebody can fall sick. Somebody can even die. So they can't control it. It's what they cannot control. So that is why human beings are not classified as assets in the financial statement of an organization. Otherwise, maybe they're going to see your name for the books, you know. So it gives the definition. It gives us how to identify the financial statements, items, the elements in the financial statement, the definitions. Now, including these items in financial statement with a monetary value. Now, you recognizing an asset. Let's say you bought a motor car. You can't just write motor car in your book. if let's say you are recognizing your PPE now, you're not saying motorcar. Somebody like me will look at you like you can't write your motorcar without having a value. So there must be a value to it. And that is what we are saying here, monetary value. There must be a monetary value to it. I'm not sure any one of us here have seen a financial statement without having values. It nullifies anything that is in that book. I mean, anything you want to mention that's nullified it, because there must be a value. We are interested in figures as a financial person. Now, linking elements such as recognizing items, one item affects another, so revenue and receivable, what that means is that let's say you sell now. If you sell on credit now, it links different elements of financial statements to each other. We have different elements of financial statement. Do anybody knows element of financial statement? Anybody? Hey, this class is too dull.
Values.
Values. Okay. Anybody else? So we have something we call elements of financial statements. So we have assets. These are elements of financial statements. We have liabilities. We have income.
Equity.
Those are the elements, right? We have expenses. I know we all know it, but maybe we don't know what it's called. We have equity, or we've forgotten what it should be. So we have assets, all these things. Is this late comer? Welcome. So all these things are elements. When we say elements of financial statement, these are elements of financial statement. If somebody that have basic understanding of financial accounting, you agree with me that this one is debit, this one is credit. They taught us in school those days, many years ago, if you can still remember. This one is credit. Somebody want to help with this?
Yes, credit.
Credit. Credit.
Expenses. Yes.
Expenses is what?
Credit.
Credit.
Expenses is debit.
Is debit, huh?
It's debit. Credit what comes in, debit what goes out.
We'll soon get there, don't worry. We'll soon get to that one now. The double entry principle, that should be in maybe like chapter 4 thereabouts. Right? Now, then we have equity. Equity is what? Debit or credit?
Credit.
Credit. Don't say it with confidence, don't worry. You are covered with the blood of Jesus. Sorry, I don't know if I'm Muslim. You are covered with anything that is supposed to be covered with. All right. So all of these are financial elements of financial statements, right? Now, it is expected that, if you want to treat your books now, you want to treat things in your book, you are going to recognize asset as debits. Anything that makes you recognize asset as credit, then you should know that you are writing letter to trouble. You are going to cause trouble. Unless you know what you are doing, that this is what you have to do to get what you want, then you can go ahead. So liability is credit, income is credit, expenses are debited, then your equity is credit. By the time you have all these things in your financial, in your balance sheet, your statement of financial position, it will give you, they will kneel off each other. When you add all of this together, they will kneel off each other, excluding these two. So these three, 1, 2, 3, and your balance sheet. So this equity, although these two, they are still there, but they will be represented inside this equity as somebody wants to remind me, retained earnings. Yeah. So that's just side talk though. So I'm just trying to link the likes of different elements of financial statement to each other. As you are debiting assets, you are crediting maybe a liability, or you are crediting, maybe you are debiting an expense, or you are crediting a liability, these things are linked together. There's no way you can do single entry record there. It has to be double entry based. So we have recognition criteria. So these are things you take into consideration when you are recording your, for instance, now assets. So is it probable that the future economic benefit will flow to the entity? Welcome. So is it probable that the future economic benefit will flow to the entity? That's one. The cost, can it be reliably measured? Those are criteria. For instance, now you want to recognize an asset. And as we've defined an asset before, is it probable that future economic benefit will float in or out of the, you can see they say into or out of the entity. If it's a liability, it will flow out. If it's an income, if it's an asset, it will flow into the entity. Now, is it probable that these things will happen? If I want to recognize an asset or a liability, it must be checked. Can the cost be measured reliably? Yes or no? No. That means I cannot recognize this. Yes, that means I can recognize it. Because if it cannot be measured reliably, it means what you are putting in the book is a wrong figure, and that will lead to being misled. So we have measurements of elements of the financial statement. So how do you measure elements of financial statement? All these things that we put here, the asset, the liability, how do you measure them? That's what is here. Number one is the historical cost. Everybody knows historical cost now, right?
Yes.
Yeah, what is historical cost? You that say yes.
Historical cost, it says that cost should be valued how would I put it? At the time they were acquired. That
Okay.
it has passed value.
Yeah. So that's the original purchase of that particular item. So that's the historical cost. So then these are the ways you can measure that particular asset, liability, income, expenses. That's the way you can measure it. What's the historical cost? Do you know it? Yes, no. Then what is the current value? How much can you, what is the current cost or the value? The current value in your book. What is the value? What is that value? Then what is the realizable value? That is especially when you have, for instance, now you have an asset, you have depreciated it over time. Now, what is realizable over that asset? What is the current position of that asset? How much, by the time you remove expenses to sell, how much can you have in that asset? Then we have the present value. This one is like using future cash flow to predict the future, the present value. So you're trying to look into the future to bring the present value into consideration. So this one you have to use formula, this P divided by 1 into bracket 1 plus R raised to power n for you to get this one, right? But I don't need that right now. I'm just saying for saying sake. So we have other accounting concepts. We have materiality. So like I said earlier, information is considered to be material if the omission or misstatement could influence users' decision based on financial statements of a specific period or a specific entity. Now, like I said earlier, if you are omitting a particular amount of money, and I think I used that 3 million naira as an instance, I said if you remove 300,000 naira from it as omission, it means you have made a material error or a material misstatement. But if it is 20,000 naira, it's still something that can still be overlooked because 20,000 naira to 3 million naira is small compared to 300,000 naira. If you take out 3 million naira from the financial statement you will see that the impact is not visible as such. Compared to taking out 300,000 naira, there will be problem. Then we have offsetting. So offsetting is a concept of accounting that says assets, liabilities should not be offset against each other. But there are exceptions to it. So we say if the accounting standard gives room for it, then we can offset it. For instance, now we are trying to prepare our financial statements and we have a certain amount of money and we look at it like, okay, we can offset this against the other. Is it permitted by the standard? Yes. If it is not permitted, then, okay, looking at this example now. So they say IAS1 permits reporting a gain or loss on disposal of a non-current asset as the value minus the carrying value. So what they are trying to say in essence is that the gain or loss on disposal of an asset, we are saying you can less it from the, of course, gain, loss, they are, how do I call it? They are element of profit or loss. The carrying amount of an asset, they are element of balance sheet. Now, meaning that you are netting off an expense against an asset. You are netting off an expense or a gain or loss against an asset. And it permits it because you can see the history of how that asset is being sold, whether it will make profit or whether it will make gain. Then we have consistency of presentation. So your presentation must have comparability. It must be consistent. Now, what they mean by that is that now I put assets, I put liability in the asset first, liability, equity. Oh my God, what's that? Sorry. All right, so I said we put asset, liability, equity like this. Now, it is expected consistency. Consistency is now telling you consistency in presentation. You cannot come and bring assets to this place in your next financial statement. No, and take this one. Say, okay, this is the way we'll be. No, the asset continue to remain here because that is the way it is supposed to be. And that is the way you have been representing it before. Just remain consistent with it. It doesn't change anything. Where it is doesn't matter, but it must continue. So far, that is the way you started it. Continue it. Then we have prudence. So we are saying prudence is a so how do I put this? So prudence is a way to ensure that we take into cognizance uncertainty in business. For instance, now let's say we have a receivable. Let's say we have a receivable of receivable. We all know what is receivable, right? Huh?
Yes, sir.
What is receivable?
Yes,
What is receivable?
debtors.
Debtors. Thank you. So these are people that are. Huh? Our what?
Our debt.
No, our debtors, not your debt. It can never be your debt. It's people that are owing you. It is receivable. It is your debtors, debtors, not your debt. Do you get it? Do you get it?
Yes, sir.
Not your debt, but your debtors. People that are indebted to you. Now, let's say you have a debtor that you want to collect 200,000 naira from. Now you look at, oh, you have a good information that, oh, business A, maybe business A is owing you this amount of money. Now you look at it, you now had information that, oh, business A is about to liquidate, so they may not be able to pay us this money. It is, or it may not even be liquidation. You have an experience that this business, they don't usually fulfill their terms and conditions, and you have a receivable from them. Based on your dealings with them, it is prudence of you as an accountant to come to your book and look at what is the percentage of the money we usually lose to them. Let's say it's 2%. This 2%, now, hold on. Sorry. So this 2% multiplied by this, it is important for you to make provision for this as a provision for bad debts in your books.
Yes, I
Because
understand the screen.
for real,
Yeah.
others, can you see my screen? Others,
Yes, yes, I can see your screen.
I can see your screen, but the document is not on.
is what?
The document is not on.
The document is not on. Like this, can you see my screen?
Yes, I can see your Excel now. Yeah, I can see your spreadsheet
Okay.
now.
You can see this
Yes,
one
it's
too.
on now. Yes, this is on now.
Okay. Easy. Can you see now? Somebody raise hand. Talk to me. You want to say something? Okay, maybe that's a mistake. Are you still raising hand, or that's okay? Let me just continue. All right. So it is prudence of you to make an assumption. I mean, to make a provision for that probable loss on your receivable. Then we have going concern. I mean, all of us know this. Going concern is when we are saying that it is assumed that a business will continue to operate for a foreseeable future without intention of liquidating. So what that means is that the business that you operate now, we will not say we are preparing it based on breakup. There's another one they call breakup basis, and that is when a business is about to break up or a business is about to liquidate. Instead of prepare it in going concern, it will be prepared on breakup basis. Sarah, can you see my screen now? Easy.
Yes, I can see your screen now.
Yes, you can see, sir.
All right, thank you. So if a business is not prepared on going concern basis, it means it will be prepared on breakup basis. The opposite of going concern is breakup basis, meaning that the business will liquidate, they will not be able to carry on the business for a foreseeable future as going concern portrays. Then we have accruals. Accruals is saying that a transaction should be recorded when it is carried out and not necessarily when there is an exchange of financial gain or loss, or an exchange of financial act. What that means is that, for instance, now if I come to buy goods from your company and I did not pay, Accra is saying record it in your book. But there's another basis that is called cash basis. We don't use that. Cash basis is saying you will not record anything until money is made, and this payment is made for that thing I bought. So Accra is saying, so far there is a transaction, put it in your book, whether there is receipt or payment of money or not, put it in your book. So that is an accrual. Then we have something we call substance over form. So substance over form is talking about how do I put it? So substance over form is like the value of that particular item over the legal condition of that particular item. For instance, now let's say you have let's say you your company is operating in a lease environment, like they borrow, they rent where they are operating. Now, if there is what we call operating lease, there is something we call finance lease. Now, finance lease is like, it's going to be for a long period of years, and at the end of that lease, the lessee is the tenant, lessor is the owner of the property. So we are saying that finance lease is a situation whereby the lessor agrees to give the lessee the ownership of the asset for a certain number of years, and that at the end of that agreement, the lessee will become the owner of that asset. Although there are still some other conditions that will be fulfilled, but that is how a finance lease operates. But there is what we call operating lease. Most rents are operating lease. Now, we are now saying that if what you are operating is a finance lease, you must capitalize it in your book as an asset, not as a rent. You know, your rent currently now, it is seen as an expense. You are just expensing it in your book. But when it's a finance lease will not be recognized in your book as an operating lease. That's what substance over form is. So truly, the owner, if you are in a finance lease with somebody now, let's say your company rents a place where they are using, but there's an agreement with the owner of the property that after a few years, this will happen, you take over the place. Now, you cannot recognize that as somebody that they can just tell, okay, wake up tomorrow, where you go, because it's a rent, it's a normal rent. That's a different thing. So substance over form is saying, yes, the lessor is still the owner of that property, but you are in the ownership position of that property. Recognize it in your book in the substance form, not in the legal, because in the legal form, the ownership still remain with the owner of the business. The owner of the property. Whereas you are just like a tenant. But then this is not an operating lease, this is a finance lease. You have to put it in your book as an asset. You have to recognize it. Substance over form. Substance over form. That's what they mean by substance. Is it clear? Did you get it?
Yes.
Yes, sir.
I love this people. Everything is clear. Wonderful people. So we have this called business entity. What is business entity? What we mean by business entity concept is not the normal buying and selling concept. We are saying business entity concept. That's what we are saying here. All these things we are saying, they are concepts. You can see materiality concept, offsetting concepts, consistency concept, prudency concept, going concern concept, accrual concept, substance over form concept, and business entity concept. What is business entity concept? You are the owner of the business. You are different from the business. Simple, straightforward. Nothing, no two way about it. Your business is a person. You are a person. That's what we mean. If it's a sole proprietorship, sole proprietorship is you are the business now. But once it is registered as a business, the law see that business as a person on his own, while you are a person on your own. So both of you are different. If you are collecting money from that business, normally it means you are owing the business, or the business is owing you. You are trying to withdraw your money back, whichever way. Anyone that enters, and that is the way it goes. So that is the end of chapter 2. Let me know if anybody here have any questions. So far, so good. Chapter 1, chapter 2. If you have any question, feel free. Let me know right now. And if your question is loading, no problem. We're always here for you to ensure that Your questions are answered. So, anybody, everything looks so clear. Nobody's talking. Sir, please, can you explain fair representation? Fair representation, Amarachuku. So, okay, Mr. Abatunde, you want to ask question, right?
Yes, please. Good afternoon, sir.
Good afternoon. Let me take the
Yes,
questions
sir.
together.
Sir.
All right. All right.
All right, sir. Sir, I would like you to go over the Accra basis accounting again. My question is on
Okay.
Accra basis actually. So I
All
want to
right.
confirm. You said that the Accra basis recognizes transactions and other events, like in the period in which those events happens, not not when the cash receipt is
Yes, sir.
when the cash receipt and payment occur. So I would like you to explain further.
Okay. 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 So, do we have any other person that have any question? Any other person? Lorena Delike, are you still raising hand? Okay, maybe just a mistake. Any other person with any question? All right. So let me start from Amara Chuku. So when we say something is a, is it, what's it called? Let me see the question again. Fair representation. So when we say something is a fair representation, it means that we are saying that so when we use the statement fair representation, we are using it for a financial statement that has been prepared. Now, when we say something is fairly represented, that's just the concept. The concept is it is fairly represented. What do we mean by that? We are saying that these things are free from material misstatements, they are free from errors, and that is why when you get to skills level, there's something we call audit and assurance. So audits will be carried out on those financial statements to ensure that the financial statements are prepared in true and fair view. Now, it does not necessarily mean, the reason why they did not say best representation is because they know that there may be some things that are non-material, just like I used that 20,000 naira to 3 million and 300,000 naira to 3 million. Just as I use that as an instance. That's why they did not say best representation. That's why they use fair, because they are trying to say this financial statement is prepared in a true fair view. In essence, what they are trying to say is that this thing to a large extent does present in a true and fair manner, like everything that are stated there, they are true to our own understanding, and there is nothing in it that once you use it to make decision, it will mislead you. There is nothing in it that will make it misleading to you, because everything that looks major in their financial statement, I mean, if you have a financial statement now, let's say you have revenue, you have cost of sales, you have gross profit, you have your expenses, you have your net profits. Now, this revenue now, let's say is 5. As it is now I have COGS. Let's say minus 3,500,000. Oh, I've made a mistake. Now, if I come to audit your financial statements, I should have a breakdown of what makes up this revenue. Now, what makes up this revenue is linked to your cash and your receivable.
Sir, I can't see your calculations
For real? Uh-huh.
on the Excel. Yes, on the Excel. It's at
Somebody
the
else can.
extreme.
Okay, it's at the extreme. How do I put it?
Yes.
You can just zoom in a bit.
Okay,
So
let me do
I
this
have
way.
zoomed. Okay.
you can zoom in on your screen
Is it fine now?
I have zoomed this, not
because I'm seeing it from my own end.
yes, I'm seeing it. I'm seeing a bit of
Oh,
it.
maybe you have no. Once you have zoomed your screen, maybe you return it back, take it back to the normal position. You'll be able to see it.
Oh,
Do you get?
okay. Yes, I've
Is it
seen
fine
it.
now?
Thank you.
Okay.
Yes, it is. Thank you.
So you're welcome. So now, what I'm trying to do is that now she has what is fair representation. Fair representation in a simple context is that what is in this financial statement, they are prepared in a true and fair view. Like the things that are there, they are good enough for you to make decision. But they did not call it best representation because they know that there are some minor things that may not be material that might have been omitted. So why did I now come here? I'm trying to justify fair representation to you. Why can they say fair representation is because now this is 5 million naira sales for the year. You have cost of sales of 3.5 million naira. Now this 5 million naira is a function of your cash or the places you will see this money in your financial statement. Apart from this revenue, is you will see the makeup in cash or receivable. So it's either they are owing you for it or they have paid you for it. So it's either it's in your bank or it's in your receivable. If it's in your bank, me that I'm auditing you, I will look at your book. I will look at it. Okay, they said they sold 5 million naira sales. Okay, how much did they sell on cash? Let's say it's 3.5 million naira. I must see that value entering your bank account. Now the remaining 1.5 million, I'm saying okay, 1.5 million naira is a receivable. I will now check. There's something they call secularization letter from auditor. So your auditor will sample. Okay, let's say that's your 1.5 million that is receivable now. Let's say it's make up of 5 different vendors. Now, those 5 different customers, rather, those 5 different customers, let's say one of them have 1 million. The remaining ones, let's say one of them have 200,000. Let's say another one have 200,000. Let's say the remaining one are 50-50. So 1.5 is complete. Now, it means that the one that carried the highest value is 1 million naira. There is 200, there is 200. You see that 1 million naira, there's nothing that will make me not to certify that that money is genuine because I'm trying to ensure that. But you see those 20,000 naira, I can overlook it because it's small compared to 1 million naira, 200. Those 1 million naira, the 1 million naira, the 200,000, I will make sure I check them because if I don't check those one and I say, okay, everything in the book is fine and you can go ahead and make a decision with it, I must have misled somebody if it turned out that what you people put in your book is not true. So when we say fair representation, simple term is that we are trying to give you that assurance that the financial statement is prepared with element of sincerity to an extent that it is free from material misstatements and it is free from material errors. That is just the simple term. So that's why I try to break it down for you like this. Is it clear? Marachuku. Marachuku, is it clear? Clear enough? Marachuku is not talking. Maybe she's in a noisy place because she typed the message. So I believe she must have gotten that concept. Now, Accra. When we say Accra, thank you. So when we say Accra, we are saying transaction should be recorded when it is carried out and not necessarily when payment or receipt is made for it. Why did we say that? That bros asked that question, and I say, let's say you are selling phones in your store now, and I say, okay, I want to come and do easy buy, because this Tinubu era, now me go help person. Okay, sure, you go give me easy buy. You say yes, I'll give you easy buy. Fine. You see that easy buy that you're giving me, that thing that make you to know how much I'm owing you, it is a Accra concept. I did not pay you now. At least, even if I paid you, I did not pay you everything. I pay you certain amounts. So Accra basis is saying record that transaction when it occurs. Now, let's say the phone is 300k. Now 300k. Easy buy. Person they do easy buy. Man, don't forget myself. I beg. Man, do easy buy. Okay, you now say if you want to do easy buy, you pay me 10%. No, 10% will be too small. You pay me. How did they do it? I don't know. Let's say you pay me 70,000 naira. How did you know? Because in Accra Concepts, how much I'm owing you now is 230,000 naira. It's 230,000 naira. But how do you know that I'm owing you 230,000 naira? It's because you recorded this phone as 300,000 naira. If it is cash basis we want to use, we'll just record 70,000 naira sale. That's all. That's what it means. So Accra basis is saying record the transaction when it happened, not when cash is paid or received for that particular transaction. So in essence, I use this as an instance. I bought a phone of 300,000 naira and I know if you pay everything finish, I pay you 70,000 naira, remaining 230,000 naira. In cash basis, you'll not be able to see this 230,000 naira. The only thing you'll be seeing is 70,000 naira. Nothing concern them. So, I mean, your company will not even see tomorrow before it close down. I will just come and buy another one again. So that's because I know you will not know that I'm owing you. Do you get it now?
Yes.
Yes, thank you. That yes is not convincing. Are you sure?
Yes, sir.
Yes, sir.
Yes,
Okay.
sir.
Thank you. Thank you. So, do anybody have any other questions? So far, so good. So far, so good. Though. Any question?
Sir, please, so,
I'm with you. Mao.
sir, this Accra concept and matching concept, are they the same thing?
Accra concept and matching concept. If they are the same
Yes.
thing. Accra concept, matching concept. Matching concept is how do we put it? Matching concept is that you are depending though. So in some cases, people use it like they are the same. But for me, they are different because why? It is you are trying to match, for instance, now let's say you make a sale of I use phone as an instance there now. So let's say you make a sale of phone for 50,000 naira. Now, matching concept is that you are matching it with the respective item that it should go with. What do I mean by that is that when you make that sale, you are debiting your bank, right? Because let's say you sold it on cash, you are debiting your bank and you are crediting your sales. And that is why, and if the money is not paid, you are debiting your receivable and you are crediting your sales. It's still the same thing. And that is why people use it like matching concepts, Accra concept, they are the same. And that's why, okay, that's why they put it here as this is also known as matching concept. So to an extent, you can use it as almost the same. But to me, no, I feel they are different because you are trying to match it with the right GL that you should go with. But the Accra concept is saying record that transaction when it happens. But then matching concept too, you record the transaction as it is occurring. But then the matching concept can still be used on cash basis because if I sell now, if I sold on in cash, I will debit what I'm supposed to debit and I'll credit what I'm supposed to credit. It's still matching system I'm using. And it does not necessarily mean that it's an accrual concept. So for me, they differ if we are to look at it from the aspect of comparing it with cash basis. Right?
Okay, sir. Thank you, sir.
Welcome. All right. So any other question? Any other question from anybody? Okay. There are no
Yes, I got
questions.
the point.
All right, go ahead. Okay. What makes up a complete financial statement? Number one, a complete
Assets.
financial statement is made up of one. Ma? So when we say financial statement, what we mean by financial statements, they are one, your statement of financial position,
Statement of
statement of
comprehensive income.
profit or loss. Thank you. Statement of cash flow, statement of changes in equity, statement of, and notes to the accounts, then comparative figures. Those are what makes up financial statements. Did you get it? Statement of profit or loss, statement of cash flow,
Yeah.
statements of changes in equity, notes to the accounts. Then we have comparative figures. So in these comparative figures, you must know that it will have the Naira sign. You must put the Naira sign because you're preparing it for Nigeria. And if it's whatever currency, you have to put it there. Right. So these are statement of financial position, statement of profit or loss, and other comprehensive income, statement of cash. So that's what makes up elements of financial statements. Is that fine? Complete financial statement, sorry. That's fine, right? Any other question? Not for now, right?
No, for now.
Okay. Thank you very much, everyone. So before we round up, we want us to do a little bit of chapter 3. We still have like 30 minutes, huh? We're tired?
No.
No.
Oh, these people are stronger.
No, sir.
Strong people do here. Oh. So we have something we called accounting equation. Somebody will know accounting equation now. Somebody tell me about it. Yeah, I've seen it on the screen already. Yeah, let me take it away. Yeah, somebody tell me accounting equation. Tell me.
Assets equal to equity plus liability.
Asset equals to equity plus liability.
Equity.
Okay, what if I say liability equal to assets? What would happen? Tell me.
If you say liability equals to assets minus equity, it's minus equity now.
Oh, this
Equity.
is wonderful. So, all right, so that's cool then. That means I don't have so much work to do here. We'll just do. Okay, I've not completed this thing. All right, so what I'm going to do, I'll open the icon pack. Maybe I'm even on it. I think I open it down. So I'll open the icon pack, then we'll use that to just do one or two things before 2 p.m., right? So, like we all know, like people have taught me, assets equals to equity plus liability. Can anybody explain what this means? Anybody? Nobody. Amarachuku, you're the one that told me now that assets equals to liability plus equity, right? Oh yeah, tell me. How? What are they trying to derive from that?
That is to say that the assets of a company is made up by their liability and their equity.
Oh, wonderful, wonderful, wonderful. You have blown my mind. You blew off my mind. Oh, that's wonderful. Yeah, so if you look at your statement of financial position, balance sheet, you will see that the addition of your equity plus your liability will be equal to assets, right? Lauren Adiliki, hey, please drop this hand, yo. This hand is just there. Okay, let me lower it on my hand. Right? Because that hand has been, the hand go down the pain himself. So, in essence, we are saying assets of a company equals to the, when you look at the statement of financial position, the assets is always the addition of the equity and the liability. Now, so we said the accounting equation is a useful introduction to the preparation of simple statement of profit or loss and statement of financial position. It's also a useful introduction to principle of double entry concepts and duality concept that every transaction has two aspects that must be recorded. I'm sure we all know that. So let me look for this icon pack. Where do I have it? No. No. A moment, sorry. Okay, this one should be FA. We can see my screen. Aha, okay. So let me zoom it. Don't over zoom. So so like we said, asset equals liability plus equity. Now we have some scenarios here. So let me open it down for you people. Amara is very smart. So we're trying to use this concept in this thing that we've just done, right? Now we have this transaction. We say Adeyemi transaction 1. Yeah, let me tell somebody to read. Who will read? Somebody. Voluntary, wonderful, melodious voice to read for us. Somebody. Abi. Nobody wants. Okay, I can go back there, right? Thank you. All right. So, read Adeyemi transaction 1.
Setting up a business by introducing capital.
Right.
Adeyemi has decided to set up in business selling football shirts from a stall in the marketplace. He begins by putting 30,000 naira into a bank account for the business.
Okay.
This transaction is recorded in the accounting equation as follows.
Oh yeah, you tell me, how will I record it? I'm on Excel like this. Oh yeah, tell me. So we said we have assets. We have asset equals to liability
Liabilities plus equity.
plus equity. All right. So now, Adeyemi. Now, they said Adeyemi set up a business. Oh yeah, peace. What do I do? What will be the double entry principle? What should I put? Put it for me. Please, you're not talking again. Anybody wants to help? Oh, yeah, now. Okay, I'm listening.
Sir, can I try?
I think Lauren person has. Cool. No question. No question. No question. I think you mistakenly raised it. Lauren, do you have any question? Ask now. Or you type it here so that we can see. Huh? This your hand is scaring us. All right. So the question is here. Somebody help. Somebody help peace. So it begins by putting 30,000 into a bank account for the business. Number one, 30,000 naira he puts is what? In the bank account is what?
Assets.
Asset.
Asset.
Right. It's an asset. Bank account. So he puts 30,000 naira. He put 30. Now, yeah. What now happened? What's that money for? The money is for what?
The money is used to setting up the business.
I
And
think
that
that's
is what?
equity.
Money used to start a
Capital.
business is what?
Capital.
Capital. These people. Let's go and meet account like this. Qualify. Capital. Capital? No. To not be here, to be here. Sorry.
Equity.
So it's going to be 30,000. Right now, what will now be our liability? Amara, you are the one that said we have. Yeah, where's liability? What will be our liability here now? Huh? Nobody.
So there's no liability. He's
There's no
starting the business.
liability. Wonderful, wonderful. So we can equally say this minus this minus. What did I press now? This minus, or I can say plus this, close brackets, enter. You can see it's giving me 0. If this thing gives me value, it means if I put something here and if I say, I didn't mean Amara have told me that I should put 1,000 here, then there will be problem, right? Well, because Amara, all of us got it right, huh? So it means we have gotten it right. Let's see what they did. So you can see it's the same. Then we have 2. Don't let me open that place. There's another solution there. Where have peace. Peace I've read. Somebody else will read now. Pisayo. Fizzy.
Yes.
Oh yeah. Where is it? Where is that? Okay, it's here. Sorry. All right. So I'm listening. Read and solve.
Adeyemi borrows 40,000 from his brother to
Okay.
purchase a motor van for the business. Adeyemi borrows 40,000 from his brother to purchase the motor van for the business. The business acquires a new asset, a motor van, but has also acquired a liability in the form of the loan. After the van,
So what are we going to put? What are we going to debit? What are we going to credit?
the 40,000.
Okay. 40,000 is what?
See,
The liability.
the liability.
The liability.
Liability. So what will I put on the liability?
40,000.
40,000.
That's loan, right?
Loan.
Yeah,
Maybe it's a loan now.
yeah,
Borrow.
yes, he borrowed. Yes.
Okay. Now, if we look at this place now, we'll be seeing that this thing is having issue. Tell me, what am I going to do next? Right? It's having issue now.
Yes.
Our assets has increased by 40,000 with that
How did it
motor
increase?
van
What
that we
increased it?
bought.
What increased the assets?
We bought a motor van
But
The
of
motor
40.
van. Motor van. 40. Right?
yeah.
You can see it's balanced. Yeah, let's
Yes.
move to another one. It's pretty simple, huh? It's simple. I don't open answer. Okay. So, yeah, Adeyemi.
Adeyemi
Yes.
buys a market store
Okay.
and puts 5,000 in cash. The
Put
business
5,000
has
naira in
used
cash. Okay.
in cash. The business has used one asset, that's the cash, to acquire a different asset, a store. There is no change in the total asset, simply a change in the makeup of the assets.
Hmm.
After the store has been purchased, the account equation changed to
Yeah. What would you change to? Oh, yeah. Nobody want to talk. So, about a store, what's a store?
A
the
store is
store is
like a
an
small
asset.
market.
A store is a what?
Asset.
Okay, they
Asset.
said it's an asset. So, I can put a store,
Yeah, 5K.
5,000. So, what will now happen? Did you get the question?
So
There's no change in the total assets, simply a change in the makeup of assets.
Oh, don't read that one. Read the question.
sir, since we used our money to buy the
Yes.
store,
Yes.
our first cash that we put into the business, we now
Yes.
reduced by 5,000.
Wonderful, wonderful, wonderful. You have said it well. So it means I'm removing 5,000 naira from here. If I had this up, you can see it's giving me nil. Why? Because did I add it well?
No, you
I
did
added it.
wrong. You added it wrongly. You added it at the Adeyemi instead of store.
Yes. So okay, we could have done it this way. Huh? Let me show you. Right. Then we could have said we paid out. So cash, because it's not, we cannot put it under, it's not a liability, neither is here an equity. We'll still put it here. It's just like you bought it's just like you pay for good in transit. You pay for good in transit, you debit your good in transit account, which is an asset, and you credit your bank account because you've paid for it. Everything is still moving within your asset. Do you get it?
Yes.
Now,
Yes, sir.
so we say cash outflow is minus 5,000 naira. So this thing automatically gives me nil. This one now, they are just there because there is no corresponding equity or liability against it. But then it doesn't mean that what we have done. Where is this one just coming? Welcome. It's okay. So we can say this is fine, right? Don't turn by this time. All right. So that's transaction. Yeah. Who will solve this? Somebody have not talked. Let me look for somebody that have not talked. This Lorena Adeleke that has been raising her. Can you talk now? No, cannot talk. Okay. So people are in these three orders. Let me see them. No, this woman was talking. Oh, John Judith. Hey, oh yeah, talk. Oh. The person that raised hand. Oh yeah, talk. Hello, are you there? Talk. Or did you send a question? Somebody raised down now. Oluwatosin. Okay. Oh. Yeah, somebody else. Read.
Adeyemi now buys some football shirts for 18,000 naira. He buys this on credit and does not have to pay for them immediately.
What will not happen? Adeyemi have checked with him.
That's the question.
Oh yeah, solve it.
Oh God.
Oh yeah, somebody want to solve it. It's almost 2.
Okay, sir. He buys it on credit. That means he did not pay for it. So that is under payables. And payables is a liability. So under our payables, we record 18,000 naira.
So I'm doing what you said. You're my director.
Jesus.
So you said I should put payable.
Yes.
Yes.
Okay. How much?
18,000 naira.
Leg it on the show here. What will I now do again?
Then since we bought the football shoe, it's our inventory. So under assets, we record inventory of 18,000.
Inventory. Why is it an inventory?
We purchased this, so it's not adding to our stock.
Okay. Okay. So I should put inventory here. Now you talk about.
Yeah. Inventory under assets, because inventory is an asset.
So how much?
18,000.
18,000. It's balanced though. That means you are correct. Right? Right. So what we're gonna do is that we're gonna end the class here by the grace of God, and we'll look at what do I do? All of us have this material, right? Do we?
So do you mean the icon
Yes, I have it.
material
Yeah, this
itself or
icon
the
pack.
image? Oh, okay.
Yes, I think I have it.
You don't think, oh, you must have it. All right, so we'll take this. Everyone will go and solve this. There is a practice question there. So this one, so everybody should solve this one. Of course, you can see solution to all this. So everybody should solve this one.
Okay.
Right? So in the next class, I think we'll just look at the remaining, or let me see if people can try it. People should be able to try. Can you? Anyway, no problem. Just do that practice one. Then next class tomorrow, by the grace of God, then we'll just do the down parts. Then we'll know we are done with chapter 3. Then we can move to chapter 4, so that we can finish up before the time runs out. So thank you all for joining. Do we have anyone that have any question again?
So can we have a recording of this class?
Yes, it's recorded, but it will not be uploaded instantly. But it will be uploaded.
Thank you, Olo. I appreciate. Sorry, I could not contribute because where I was pretty noisy.
Oh, we were seeing your hand. We just did not hear
It
you.
was mistakenly, and the thing was just coming up itself.